Welcome to Deep Dive. Today, we're talking about a really pivotal decade, financially speaking, your 50s. If you're listening, you probably know this time often brings some big shifts. Maybe peak earning years, maybe kids are finally, finishing college. But that thing called retirement suddenly feels less like a distant concept and more like, well, a deadline looming pretty large.
Yeah, and if that looming deadline is stirring up some anxiety, maybe that feeling like, oh, I should have done more 20 years ago, or I missed the boat somehow, let's just tackle that right now. Our sources are really clear. That kind of thinking is just a trap. It's not helpful. It is absolutely not too late. Honestly, the 50s are more like the start of a new chapter, a smarter one. It's a time to get really intentional about building that financial freedom. Stop worrying about yesterday.
Intentionality. That really is the key word, isn't it? So our mission here today is to cut through all that noise, that stress. We want to give you a clear step-by-step strategy, show you exactly how to use the tools available right now in this decade to build a solid cushion for your 60s and beyond. Focus on action, not anxiety. Okay, so let's unpack that. The very first move, the foundation really, is swapping that vague worry for concrete clarity. We see it all the time, right? People are busy, life happens, and their financial picture is kind of fragmented. A statement here, a bill there. The goal is to see it all in one place, the whole landscape.
Exactly. Think of it like a Fidalia, like a full dress rehearsal for retirement.
Yeah.
You absolutely have to know your starting point before you can chart the course forward. And the most powerful exercise for this, it's calculating your net worth. Simple concept, really. Take everything you own, cash, house, investments, all that.
Right.
Your assets.
Right, all the assets.
And then subtract everything you owe. Mortgage, car loans, credit cards, student loans if they're still around, everything. Seeing that final number, just one single number, it has this huge psychological impact.
It really shifts your perspective, doesn't it? From just thinking about saving money to actively thinking about building wealth.
It absolutely does.
Uh-huh.
And tied right into that net worth piece is getting a handle on your spending, a meticulous spending track. Our sources really hammer this home. Track everything for a full 12 months, not just a month or two.
A whole year.
A whole year. Because you need to capture everything. Holidays, insurance popping up, summer AC bills versus winter heating. You need the real picture of your lifestyle costs.
And I bet that tracking process shines a bright light on what some experts call financial leaks. You know, those little recurring things that just sort of drain your cash without you really noticing or getting much value back.
Oh, definitely. Think about like multiple streaming services you hardly watch, or maybe that gym membership you keep meaning to cancel.
Or that free trial that auto-renewed a year ago. Happens all the time.
And those leaks add up fast. I mean, the sources pointed out the average person might have, what, 5, 7 unused subscriptions? Easily over $150 a month. That's almost $2,000 a year just vanishing. Finding those leaks and plugging them, that's like giving yourself an instant raise. Easiest money you'll find. There are tons of free budget calculators online that can help you get that kind of holistic view, see where it's all actually going.
Okay, so once you've got that clarity, you've plugged the leaks. Now we get to the really powerful stuff. This decade, your 50s, it offers unique advantages, things younger savers just don't have access to. We're talking about catch-up contributions. These are like financial superpowers designed to help you accelerate savings right when you need it most.
They really are a gift, especially if you do feel like you got started a bit late, maybe in your 30s or 40s. These catch-up limits, they're substantial. They're specifically designed to let you make up ground quickly in these final working years. Let's look at the 2025 numbers because they're pretty impressive.
Yeah, lay those out for us. What can people actually put away?
Okay, so for your main workplace plan, like a 401k or maybe a 403b, the regular contribution limit is $23,500 for 2025. But here's the key. If you're 50 or older, boom, you can add an extra $7,500 as a catch-up. So that brings your total potential contribution to $31,000 in 1 year.
31,000, that's already a big jump, but there's even more, right? Thanks to the Secure 2.0 Act.
Exactly right. Secure 2.0 added another layer, kind of a hyper catch-up for a specific age group. If you're between 60 and 63 years old, that extra catch-up amount jumps even higher, goes up to $11,250. Add that to the base limit. You're looking at a total possible contribution of $34,750 in those specific years.
Wow.
It's a massive opportunity to really turbocharge that tax-deferred growth right before you might need it.
Nearly 35 grand into one account. That is serious acceleration potential.
Absolutely. And remember, that's just the employer plan. We also have IRAs, traditional or Roth. The standard limit there is $7,000.
Right.
But again, if you're 50 plus, you get an extra $1,000 catch-up. So $8,000 total into an IRA. And then the third piece, if you have a high deductible health plan, you absolutely need to look at the health savings account, the HSA.
Ah, yes, the HSA, the triple tax advantage vehicle we always talk about. Contributions go in pre-tax, it grows tax-free, and withdrawals are tax-free too, as long as it's for qualified medical stuff.
It's unbeatable, honestly. For 2025, the limits are $4,300 for an individual plan, $8,550 for a family plan. Plus, and this is key, there's a $1,000 catch-up here too, but this one starts at age 55, not 50. So if you're 55 or older, you can potentially add that extra grand. Maxing out these accounts, 401k, IRA, HSA, should be top priority in your 50s if possible.
Okay, so we're maximizing savings with these catch-up tools. Fantastic. But we have to address the elephant in the room for many people: debt, specifically high-interest debt. Carrying that into retirement, it's just incredibly risky. The sources call it a wealth killer, and that feels about right.
It really is. And you need a strategy to eliminate it. Not just pay it down slowly, but eliminate it strategically. Focus fire on the high-interest stuff first. Credit cards, maybe some personal loans. Think about the math for a second. If you're paying, say, 26.99% interest on a credit card,
Yeah.
which isn't uncommon, but your investments, even in a good year, might be earning 7%.
You're losing money.
You're actively going backward.
Yeah.
Paying off that 26.99% debt is like getting a guaranteed tax-free return of 26.99%. You can't beat that anywhere else.
Okay, but that brings up the tough question. Let's say someone's got limited funds, high interest credit card debt versus maxing out the 401k to get the company match. What's the priority?
The classic dilemma. It's tough. Generally, that guaranteed high return from paying off debt is compelling. However, if your employer offers a match on your 401k contributions, say dollar for dollar up to a certain percent,
What's in free money?
that's basically a 100% instant return on your money. You absolutely cannot leave that on the table. So the consensus advice is contribute enough to get the full employer match first. That's priority one. Then every single spare dollar after that goes towards demolishing that high interest debt. Maximize those guaranteed returns first.
Got it. Match first, then debt massacre. Makes sense.
Precisely. Now, what about lower interest debt? Like maybe you have a mortgage locked in at 3 or 3.5% from a few years ago. Here, the strategy kind of flips. The advice is generally to prioritize maxing out those retirement catch-up contributions before you make extra payments on that low-rate mortgage. Why? Because time is running out to use those powerful catch-up windows. The potential growth in those tax-advantaged accounts over the next 10, 15 years likely outweighs the small interest savings on the low-rate debt.
And what about tactics to lower the cost of existing debt? We hear about balance transfers for credit cards.
Absolutely. Transferring high-interest credit card balances to a card with a 0% introductory APR can save you a ton in interest, giving you breathing room to pay down the principal. Just watch out for transfer fees and make sure you can pay it off before the intro rate expires.
Right. And refinancing a mortgage, people might think about that to shorten the term.
Can be tempting, but you need to be really skeptical here. Run the numbers carefully. Make absolutely sure the long-term interest savings will genuinely outweigh the closing costs you'll pay up front. Sometimes refinancing looks good on paper, but doesn't actually save you much, or it strains your monthly cash flow too much. Don't spend money just trying to save money,
Okay, makes sense. So savings optimized, debt under attack. Now let's talk about the other side of the equation: income. You've likely built up decades of valuable experience by your 50s. How can you leverage that, monetize it strategically?
This is such an important area, especially if you're in a professional field. We need to think beyond just generic side hustles sometimes. It's about leveraging that deep expertise you've built. For many experienced professionals, high-value consulting or maybe fractional executive work is a really viable path.
So instead of, say, driving for Uber, you're offering specialized advice in your field, like project management or marketing strategy.
Exactly that. Using your specific skills, your industry knowledge, to work part-time but at a high rate. Sources suggest looking into things like fractional CMO roles or maybe offering specialized training or project-based consulting in your niche. Companies often pay premium rates for that kind of targeted expertise without needing a full-time hire. It brings in cash now, plus it keeps your skills sharp, keeps your network active, could even be a bridge to a phased retirement later.
And for folks with maybe a different kind of skill or hobby, turning that into a side business, maybe custom woodworking, graphic design, specialized coaching that generates cash, you can funnel directly into those catch-up contributions.
Definitely. And don't forget passive income streams, though these usually need some upfront capital or effort. Things like rental properties, maybe dividend-paying stocks. They can build income that doesn't require actively trading your time. But while you're looking at income and savings, your investment strategy itself needs to evolve too.
Right. Can't keep riding the super aggressive growth wave like maybe we did in our 30s. The timeline's shorter now.
Precisely. As retirement gets closer, the focus has to shift from purely maximizing growth to also protecting what you've built. Preservation becomes key. So now is the time to really review your asset allocation. Are you still too heavy in aggressive stocks? You likely need to start gradually shifting towards more conservative investments, maybe more bonds, more fixed income type assets. The goal is to insulate your nest egg from big market swings in those critical few years right before you plan to start drawing down that money.
Okay, that leads us perfectly into the final piece. Future-proofing. Looking beyond just the immediate budget or savings goal. We need a long-term vision, right? Not just about having enough money for retirement, but having the freedom to live well. And that means planning for some big, sometimes unpredictable costs.
Yeah, the first hurdle is just projecting expenses accurately. Most people use that rule of thumb like, oh, I'll need 70 or 80% of my current income. But that's often too simplistic. Sure, maybe commuting costs go down, but what about other things? More travel, new hobbies, and the big one, healthcare costs. Those can easily balloon and derail a plan that looked solid otherwise.
Healthcare is definitely the wild card. The numbers are pretty sobering. Sources mention a 65-year-old couple retiring today might need, what was it, around $165,000 each just for out-of-pocket medical expenses throughout retirement, beyond what Medicare covers.
It's a huge number, and it catches people off guard. Medicare covers a lot, but not everything. Long-term care, for example, is a massive potential expense. Now, traditional long-term care insurance, it's gotten really complicated, often very expensive. So a common strategy now is planning to self-fund, at least partially. The advice often involves setting aside enough liquid cash or easily accessible funds to cover maybe 2 or 3 years of potential high-level care costs. This might be in dedicated savings or sometimes structured using specific types of annuities. Maximizing that HSA now helps build that buffer too.
And this also connects to something really critical but maybe less obvious, tax strategy in retirement. It's not just about minimizing taxes this year, it's about minimizing your lifetime tax bill.
This is where planning gets more sophisticated, but it's so important. We need to talk about tax diversification. Ideally, you want your retirement savings spread across 3 types of accounts. Traditional pre-tax accounts, like a 401k where withdrawals are taxed, Roth accounts, where qualified withdrawals are tax-free, and regular taxable brokerage accounts. Why? Because if all your money is in traditional pre-tax accounts, when you hit age 73, you'll face required minimum distributions, RMDs. The government forces you to take money out, and it's all taxable income. Those RMDs can be huge and push you into much higher tax brackets right when you might want to control your income.
Okay, so the main tool to manage those future RMDs and control taxes later is the partial Roth conversion.
Exactly. This is a powerful strategy for your 50s and 60s. You take money from your traditional IRA or 401k, move it to a Roth account, and you pay income tax on the converted amount now. Why do this? Because you might be in a lower tax bracket now than you will be later in retirement, especially once RMDs and maybe Social Security kick in. You're essentially prepaying the tax, reducing the size of your future taxable withdrawals, and creating a pool of guaranteed tax-free money you can draw on later. It gives you immense flexibility and control over your tax bill year by year in retirement.
That sounds like a really smart move, but definitely something that requires careful planning, maybe even professional advice. And one last crucial step, not strictly financial, but essential, estate planning basics.
Cannot stress this enough. And it's not just about having a will, which dictates what happens after you die. What you need right now, while you're living, are things like a durable power of attorney for finances and a healthcare power of attorney or healthcare proxy. These documents appoint someone you trust to make financial and medical decisions for you if you become incapacitated and can't make them yourself. Having these in place can save your family an incredible amount of stress, money, and potential legal battles if something unexpected happens. It's about protecting yourself while you're alive.
Wow, okay. We've covered a lot of ground. But the core message seems really clear. Your 50s aren't about panic. They're about focused, intentional action. The opportunity is definitely there, and the tools like those catch-up contributions are really powerful.
Absolutely. The key is to let go of any past regrets about what you maybe didn't do. Focus forward. Use those catch-up contributions. Attack the high-interest debt. Look for smart ways to leverage your experience for extra income now. Building wealth, securing your future. It's absolutely achievable starting today. You have the power to make a significant difference in this decade.
So for everyone listening, feeling maybe a little overwhelmed, but also motivated, what's one small, concrete step they could take this week? just to get the ball rolling?
Great question. Don't try to do everything at once. Pick one thing. Maybe this week you finally sit down and calculate your net worth. Just get that number. Or maybe you brainstorm 3 specific ways you could use your professional skills for some part-time consulting. Just take one small, intentional financial action, build that momentum. It makes the next step easier.
Love that. Start small, build momentum. And as a final thought, something for you to chew on as you start thinking more seriously about that retirement transition. Because you're hopefully starting to think about tax diversification, now you need to consider your spend down strategy.
That's right. It's not just about how much you save, but how you take it out. Ask yourself this question. When I retire, what account will I pull money from first? Will it be the traditional IRA, the Roth IRA, your taxable brokerage account, maybe cash savings? The order in which you liquidate those different account types can have a massive impact on how long your money lasts and how much tax you pay over your entire retirement. Defining that withdrawal strategy isn't something to figure out on day one of retirement. It's a strategic decision you should start thinking about and planning for right now.